Good morning, everybody. This is the live market open for Tuesday, December 15th. I'm Yohay Elam, Forex Crunch and Market Movers podcast, doing the show as usual for FX Street. It's one day ahead of the Fed, and let's see what's going on. As usual, we'll cover recent developments, charts and levels, talk about the next 24 hours, and of course, answer your questions. If you can't see the chat box on the screen, please go to the address that you can see right here, tlk.io/fxstreet-forex-live-video. Okay, so let's begin what we had yesterday. Yesterday we had another crash in oil prices. They fell again to the lowest levels since the financial crisis. They fell to the 34 handle, and within the Canadian dollar reached, we talked about dollar CAD going for the sky, another sky high level, but we had a rebound from there. We had a fall. One of the things that triggered this turnaround in oil prices was that the Nigerian oil minister said that if prices remain this low, an emergency meeting will have to come in February. This is an emergency meeting, of course, of OPEC, even though they control only a third of the market. Okay, another reason for the fall earlier this week is that the Iranian oil minister said that they're ready to come back online once sanctions are lifted, and they already have customers for their oil. So I'm talking a lot about oil these days, but it really has a lot of impact on markets. Okay, so that's what we had yesterday. Another thing we had yesterday is I was talking a lot yesterday about Draghi's speech, and he didn't say anything new. He didn't impact markets. Euro dollar, in fact, is a bit higher. We've seen that because of a few things. Short squeeze. That means the liquidity is quite low in markets. This will continue accompanying us until in the next 3 weeks, actually until early January. And other thing is that was risk aversion with falling oil prices, worries about global growth, worries about China, worries about the rate hike, of course, in the United States. And another reason for the strength of the euro, the Draghi didn't say anything. During the night, we had Australian meeting minutes of the recent RBA decision. The headline regarding the Australian dollar was that the fall in the Australian dollar is in line with commodities, basically everything we already know. Okay, so they didn't really say anything new. It didn't have an impact on the Aussie. So let's look at a few charts, and before we move to today's data. All right. So this is euro dollar reaching new highs as we speak, making higher highs, breaking above the previous highs. So we can see here 109.80 was the high seen when Draghi began after the Draghi disappointment. Okay, since then we had a drop, a dip under 108, and another move higher, stopped around 110.50. Now we're rising a bit higher. 110.70 might be another resistance. It used to be such a line in the past. So far, the high is 110.69. So the euro is a funding currency, okay? Because we have negative deposit rates in the eurozone, and we have also we have, of course, the ECB printing money. So investors take money in the eurozone and use it elsewhere. But in times of trouble, this money is repatriated. So that's one of the phenomena we're seeing now. In addition, it's also another shock wave from the Draghi disappointment. So to the downside, we have 110, not so strong anymore. I would say this line we talked about beforehand, 109.25 is of importance. So the downside followed by 108.30. On the top side, perhaps 110.70. But if we take a better look, perhaps if we look further above, if we're seeing these gains continue, 111.40 and then 112.15. Okay, these are the lines to watch in euro dollar. I still see the general direction as being to the downside because of monetary policy divergence, but all this fear in markets is taking a toll on the US dollar, which is sort of in the middle between the safe haven currencies such as the dollar and the euro and the yen, and the commodity currencies. Okay, let's talk about the pound. Yesterday, something I didn't write on the slide, we had a speech from Shafiq, a member of the Bank of England. She had a mixed message. On one hand, the next move will be to raise rates, as we know. On the other hand, the current interest rate, which is with us in the United Kingdom for nearly 7 years, is not the lower bound, so they can always lower rates. Anyway, we're more or less bang in the middle of recent ranges, when 150, 145, 152 is resistance, 150, 115 is support. We have a few events in the UK. We'll reach those events quite soon. Dollar yen, you can see here on the screen. Well, this is exactly the risk trade. More worries, more flows to the yen. So we've seen a low today of 120.57, but yesterday we've already been below 120.40. Okay, 120 is of course a very round number of support. I'm really impressed by the technical behavior of the chart regarding the 122.20 line. Look how it worked as support for a long time. Clear separator of ranges, and an attempt to move higher met this line. Now we're back down. Here it's, well, recent days have been a bit more choppy. In general, more worries positive for the yen. Another thing to remember, yesterday, last night, we had in Japan the Tankan figures. They were better than expected. So yet again, less chance for action from the Bank of Japan, and this implies, of course, higher chances for stronger Japanese yen, or at least it does not support the it doesn't support a stronger dollar yen. Okay. Dollar CAD, of course, one of my favorites because of all the action we've seen there. Yesterday they got close to 138. I don't draw too many lines here because it's a bit wild with oil prices. Okay, so 136.20 is still some kind of support because it worked as a small double top, and then afterwards it's only 134.60. To the upside, let's draw a line on the higher line that we've seen so far. Let's see if it can work as resistance. I doubt that. Okay, so at least we have no 137.87. Okay, that's the high line. Just because it was high yesterday doesn't mean it's the limit, doesn't mean it will work as resistance. I think resistance is somewhere, well, 140, the round number. Okay, Australian dollar had its thing. Technically, the 72.80 line remains an impressive separator of ranges. Look how nicely it worked here in November as a support. As resistance, and then here as support. Then it fell to lower ground, and another attempt to, well, it moved higher, used it as support once again, and now again it's resistance. Very impressive technical behavior there. I still see 72.20 as some kind of support, but it's more serious support is at 71.50, resistance 72.80, 73.60. Kiwi dollar is doing really well. We have, well, good reasons for the rise. Last week we had a cut in New Zealand, yes, but they said that rates are expected to remain steady and that the exchange rate is only unhelpful, not unsatisfactory, unsustainable, or unjustified. Anyway, we had a break above the 67.90 level, and the next move is the next level to watch there is 69. So we've seen sort of, well, this, for the Kiwi, it just turned into a sell-off of the US dollar, and the Kiwi had reasons to rise on its own. It did retreat a bit when things got a bit scarier, but when oil prices rebounded once again, it has had room to rise. Okay, dollar Swiss leaning a bit lower, not going anywhere fast, a bit attached to the euro. Maybe we can add another line here, but remember the Swiss National Bank intervenes, so it's not the best pair to trade. So we have 97.82 more or less over there, euro Swiss. Look how it almost always during our show trades at the 108 handle, a bit above. It did dip below 107.60 is support, as you can see here on the chart, and resistance at 109. Euro pound is a bit stuck. Euro is moving higher, so we've reached 73. It's a line we've mentioned in the past. So let's see if it works as a double top or just a stepping stone on the way up. Euro finds reasons to rise nowadays. Okay. Euro yen, well, hugging this kind of line here at 133.15. Not so nice technically. 134 resistance, 131.50 support. Pound yen, well, these safe haven flows favored the yen, and the pound was a bit stuck. 182.88 at the moment. We've reached touched support there at 182 yesterday, and now I would say 182.50 is some kind of support, followed by 182, and on the top side it's a bit choppy there. Lines are not that clear, but I would say 183.80 would be resistance. Okay, let's take another look at the price of oil that we have right here. 36.12 at the moment. We dipped below. We reached 34.50 yesterday. Really crazy charts today. Well, in the past recent days in oil prices. So we talked a lot about markets. Let me see if we have any questions before we talk about the events for today. So good morning, everybody. Yeah, a question from Fabian: do you see euro dollar keep going up today during London session, or do you see the London session pushing it back to a more fair value? Well, it's a bit messy with the euro dollar. We have the German zoo indicator. It could give the euro another boost because it's expected to be positive. We'll talk about the events quite soon. Okay, so I believe we could see another move higher before the US session begins. And once the US session begins, I think we'll have some squaring, we'll have some positioning towards the Fed tomorrow. We'll talk about that, of course. Talked about that a lot. FX Robot Trader, I don't know who you are. Question. Good morning. Oasis boy. Well, good to see you here. You are asking about what's the relation between the stock index and currency? I mean, euro dollar and the DAX. Well, this is more or less correlated directly. Okay, so euro dollar rises with the DAX, rising stock prices. Well, no, sorry, depends on the ECB. When we had let me rephrase. When we had the ECB meeting on December 13th, we had a disappointment. We had less monetary action than expected. It was bad for stock prices, especially in the eurozone, but positive for the euro. Okay, so we've seen that kind of correlation. So I would say that that's the current correlation, but it doesn't always work perfectly well. In general, global stock markets move together, and when they move higher, well, DAX moves higher. It's good for it's sort of bad for the euro because, but things are a bit complicated over there. So we've seen that reaction with the ECB, but this reaction doesn't always happen. So I don't have sort of a clear-cut answer. Okay, there is because so the euro is also a safe haven currency, so that's why we've seen that. But at other times, so if the ECB were to print more money, okay, then we would have higher stocks because of this money and a weaker euro because money flows out of the eurozone. So in general, there's an inverse relation, but it's not always a clear cut. X-Tax, I don't follow. We're talking here more about Forex, and I do touch a bit about S&P and of course oil, but less about I have another question here about Oasis Boy. Reason for rate hike with the Fed because of the inflation. No, the Fed doesn't fear deflation at the moment. It sees inflation in general as steady. It assumes that as markets become more normal, as the US economy improves, as things get back to normal state of affairs, prices are going to rise. We're going to have more inflation, and then we have, of course, at the moment we're seeing more employment, more growth. Eventually, we'll see higher prices and higher wages. Will also support, will push inflation higher. So the Fed wants to mitigate that, to get ahead of the curve, to raise rates, and sort of to depress demand just a bit, not to choke the recovery, of course, but to depress demand just a bit, so that inflation will remain at these kind of levels and will not get out of control. Okay, so and of course they don't want to create a situation of deflation. Okay, so I hope this answers your question. Sorry. Fix Robot Trader, if you have questions regarding the session, you're welcome. That's the purpose of this chat at this time. Okay, not other things. Okay, let's get back to what we have today on the agenda. So in the meantime, while I was answering your questions, we're seeing a change. Eurodollar is sliding just a bit. It's important to remember we're in December. We're 1 week away, a week and a half from Christmas. Okay, so liquidity is much lower than usual, and this is of course means that movements can be a bit stronger. So we've seen Eurodollar dip just 20 pips in a matter of a few minutes. As far as I know, we didn't have any specific developments, but we do have quite a few developments coming up soon. Okay, so we had final inflation figures from, this is the FX Street calendar on Forex Crunch. We had a few inflation figures from Spain. They were final, not so interesting. We have here the we have UK inflation data at 9:30 GMT. That's 10:30 in the old continent. Okay. The most important thing to watch here is year-over-year inflation in the consumer price index in the CPI. That stood on 0.2 last time. It's expected to rise to 0.5. All right. Oh, sorry, that's the US figure. Sorry. I'm confusing you all. Why don't I have that on the screen? Just a moment. And let's get it up on the screen. It's of course critical because the Bank of England sets its policy. It has a single mandate of inflation, and when they have an inflation goal of 2% or 1 to 3%, and when they don't meet this goal, the Bank of England has to write a letter to the Chancellor of the Exchequer explaining why they missed the goal. Anyway, it's of course they blame oil prices, which we've talked about in length. So the most important figure here to watch is this one, consumer price index year over year. It stood at minus 0.1. This time it's expected to rise to positive ground to plus 0.1. Okay, but since oil prices have such a big impact, such a depressing impact, many will watch the core prices. They did surprise to the upside last time by rising to 1.1. We don't have expectations for that, but in general, if it's a bit better than that, it's positive. If it's lower, it's negative. The Bank of England saw the half glass empty, talking about the situation in wages as flattening. So we have 3% year-over-year rise in wages, but they don't see that as sustainable. Okay. In addition, we have also the retail price index, the producer price index, all this kind of lots of data. But remember, first of all, watch this headline CPI and then core CPI. Okay. Then at 10 GMT, we have the ZOO figure I mentioned before in Germany. Economic sentiment is the headline. It's expected to rise from 10 points to 15 points. So that means an improvement. You can see here on the chart we had a big fall in this indicator during 2015, but in recent months we had some kind of rebound. Okay, we almost fell to negative ground, almost fell to a situation where, according to this survey, investors and analysts and industrialists were pessimistic about the economy, but we're seeing it rise once again. Another component to watch here is the current situation. So not only the economic sentiment for the future, but the economic situation. And here it's a bit more steady on higher ground since the went up during the year and quite steady since then. Okay, what else do we have on the agenda? Well, perhaps the last figure for the Fed to consider. I even have a rhyme here, even though I'm sure the Fed already made its decision. But remember, the Federal Reserve in the United States has two mandates: inflation and employment. Employment is looking good. The last NFP was good. Inflation is sort of mediocre, sort of stuck. But contrary to the United Kingdom, what's important in the United States is not headline inflation. Of course, we know that's influenced by oil prices, but core inflation. Also, year over year is more important. Last time we had 1.9. It remained steady. This time we're expecting a small rise to 2% year over year. Now, that's the target of the Fed, around 2% year over year. Now, the Fed looks at another figure, the core PCE price index, not only at this core CPI, but if we indeed have only a rise to 2%, I believe that the current situation in euro dollar, for example, or in the dollar in general, we've seen the dollar on the back foot, it could get a boost. We've seen how slightly better than expected consumer confidence on Friday helped the US dollar rebound. Remember, markets are very choppy. Volatility is high, so trade perhaps with wider stops and with smaller leverage. Okay, so it's 2% expected year over year. The headline is expected to rise from 0.2 to 0.5 year over year. Remember, there are also base effects here. That means that if you remember these are figures for November. In November last year, oil prices began their big tumble. Since then, they've stabilized, went up, went down, and now we're seeing a resumed a resumption of this fall. In November this year, they were more steady than in November last year. So we can see this base effect moving out. Okay, so watch core inflation more than headline inflation. At 1:30 GMT, we also have the Empire State Manufacturing Index. This is a very early indicator, I think, if I'm not mistaken. Let's see if we have it here. Yeah, it's an early indicator for this month, for December. It has been quite depressing in general. The manufacturing sector in the Western world in general, and in the United States in particular, is not has seen better days. So the developed world is undergoing in deindustrialization. Anyway, this has been negative minus 10.74, and this time we're expecting a rise to minus 5 points, which is still in negative ground, still reflecting sort of squeeze in manufacturing. Okay, and later we have, well, at the same time, Canadian manufacturing sales. This could have a small impact on the loonie, but remember, oil prices, impact the Canadian dollar. Somewhere around 3 GMT, 4 GMT, we will have milk prices from New Zealand. I don't think we have official expectations here, but we do have. Yeah, and there's no time. Just remember, last time we had after 3 consecutive falls, we had a rise of 3.6%. I think that in the current situation of the Kiwi, where we have a central bank that is quite optimistic, just a small rise of 0.5% will be good enough. A fall will be disappointing. Milk is a soft commodity, soybean soft commodity. It's not like the hard commodities that Australia sells, like iron and copper. Okay, and we have at 4:45 GMT a speech by Stephen Pelosi, the governor of the Bank of Canada, and this will already have more impact on the Canadian dollar. This could compete with oil prices. Okay, let's take another look at dollar CAD. It's a bit sliding now, because on one hand they expect interest rates to remain unchanged. Okay, and some things look good in the Canadian economy. On the other hand, in a recent speech, he said that minus 0.5 is the lower bound. We're currently at plus 0.5. So there is a potential to fall there. Let's see if he repeats that. If he provides us a hint about the Canadian Central Bank, the BOC, ready to cut rates in 2016. This could have a depressing depressing impact on the Canadian dollar. I'm not sure this will happen, of course, but it's something to watch out for, especially with falling oil prices, and especially, that the Canadian economy is a bit looking for a new direction, let's call it this way. Okay, so these are the main events for today. Let's see if you have more questions. Quite a few messages here. So, question from Oasis Boy: if the US is not facing deflation, then the ECB is facing deflation. That's QE extend period. Yeah, in the Eurozone, there's a fear of deflation. Core inflation is weak, and also headline inflation, and the unemployment rate is higher. The ECB's actions did have a positive impact, but there is a fear of deflationary mindset when people don't invest because they expect prices to fall and nobody to buy them. So that's why they extended QE. They also cut the interest rate, and they're ready to do more. Of course, they hinted about lots more, so markets expected more, and that's why we had a disappointment. But in general, there is a real fear of deflation in the Eurozone and not in the US. Jax asks, think US dollar will get pushed up until Fed then falls, rise to 111, 112.50, drop below 104. What levels do you see? Okay, levels regarding euro dollar. The big levels to watch in case, first of all, let's talk about the case that the Fed doesn't raise rates tomorrow. Then the levels to watch, the big levels, we could have huge moves, would be to the top side. Sorry, I'm in the Canadian dollar. So on the top side, well, first of all, we're close to some kind of resistance right here, but 111.30, 112.15, and the big levels 114.60, which was some kind of triple top, or a range 114.60 to 115, and then 117.12, which was the swing high in August. Okay, on the downside, I still see 108.30 as a separator of ranges, despite this dip, followed by 107.60, 106.30, 105.20, which was the post-Ruggie. No, sorry, let's put it at 105.30, and 104.60, which was the low of the year. I do expect the US dollar to strengthen on a hike because, first of all, a hike is a hike. It's not 100% priced in, and if it's priced in and further action also is priced in, then we'll have sort of, I mean, the scenario for the dollar to fall is that the rate hike is priced in, but then the Fed will send a dovish message saying that it will raise rates very, very slowly. Okay, so and this will of course be depressing for the US dollar. But if you assume that the rate hike is priced in, so also a dovish message is priced in because the Fed also said that dozens of times. Okay, so more questions, Fabian. Good morning. What about if euro dollar is just doing a false break and will continue down? Yeah, we had just comment on that. We had lots of false breaks. So yeah. A question here. Euro dollar continues to stay under 110. Certain break on it, no, should be in Dutch. Okay, thanks for the comment. Yeah, if we have too many attempts that don't succeed to push euro dollar higher, you could see it break down. You know, what cannot rise eventually falls. Jack says thinks the big boys are pushing euro dollar, so euro will become completely worthless. It could be. There could be some. No, it's a political union, and the political union needs a stable currency. I think the ECB would prefer something around parity, but also 110 is not a disaster. It's not the disaster that was 140. Okay, Waiting TRY to stay and break under 1030. Okay. See bearish wedge. It could finally break down. I don't see there a bearish wedge. I see more messy behavior, low liquidity, and high tension towards the Fed. Okay, the central banks already know the Fed decision and how much the Fed hike will be. Well, I think everybody knows the Fed will hike from the range of 0 to 0.25 to a range of 0.25 to 0.50. That's mostly priced in. Okay, let's also look at about what bond markets imply. Okay, this is the CME Group FedWatch tool, and it stands currently at 83% for rate hike. It's even higher than levels we've talked about yesterday, which were 79%. Anyway, this is also, if you read surveys of economists, that's already priced in. Okay, the bigger question is, what will they hint towards 2016? It's between one and done, no rate hikes anymore, or on the other hand, if the or up to 4 rate hikes every meeting that they have a press conference in. That means March, June, September, and December. I think the truth is somewhere in the middle. I believe we'll have 2 rate hikes next year, and that we'll see an initial strengthening of the US dollar, but then a fall. So, yeah, key levels, we talked about that. Yeah, I see your comment here about FX Robert not to trust economic weekly calendar. I think that economic events do have an impact, and the calendar is important. Anyway, I focus more on fundamentals than on technicals. Okay. Anyway, do you have questions about fundamentals, everybody? Let's perhaps take another look here at 110.32 is the current level. Lots of choppiness. 110.60 is the high so far. Okay, let's talk a bit about other events that we have this week. Or let's do a conclusion of the Fed. First of all, rate hike is expected. It's going to be tomorrow. If it doesn't come, it will lead to a crash in the US dollar. It's not fully priced in my opinion. A hike is still a hike. It's still a different direction that we're seeing in the Eurozone, for example, in Japan and in other countries. They will repeat the message that they're saying for a very long time, that the rate hikes will be gradual, that it's mostly, and I think also that could be a bit priced in. That means a dovish message would not depress the dollar too much, because that's expected. And of course, the Fed is data dependent. It's also important to remember. That. Put my face here once again. Can you see me? Yeah, different office this week. So it's also important to remember that when the Fed releases 4 other things, if you wish. No, 3. They release forecasts for inflation, GDP, and employment. Okay, so the employment figures could be pushed a bit to the downside because unemployment is falling, right? So it can be pushed below 5%, and they'll have to explain where full employment is. It's probably below what is traditionally expected because the participation rate is low. Second thing, GDP, more or less the same. Perhaps a downgrade. Usually the Fed is a bit optimistic, so they might leave it at somewhere between 2 to 2.5%. Less important, and inflation, core inflation, core PCE. Expectations are for just under 2%. I believe that will remain stable despite some fears that inflation is falling. Okay, So one thing is these forecasts. The second thing is what we call the dot plot. Okay, that's where Fed members, all 17 or 19 of them, the voting members, the 10 voting members, and the others that don't vote, where they want to see rate hikes at the end of 2016, at the end of 2017, or in general. That implies the pace, okay? So everybody expects that to be lower, okay? And it's important to look not only at the pace, where it'll be at the end of 2016, but at the final rate, which is expected somewhere in late 2017. How high will it go? So in the past, it used to be around, the normal used to be about percent, even 5% would be peak interest rate in good times. Now it's a bit, they lowered it one time to 3.75, and now it's expected to be around 3. Expectations, they vary between 2% to 4%. Of course, if they lean more to the downside, long-term interest rates to remain too low for too long, that's of course depressing for the US dollar. I believe they'll be around the middle of expectations, around 3%. Okay, and the third event to watch, so we have forecasts, we have the dot plot regarding interest rates. That'll have the first and most important impact at 7 GMT when it's released. And the last thing to watch is, of course, the press conference by Janet Yellen that begins at 7:30 GMT. It'll be covered, of course, by FX Street. I still don't know personally if I'll be able to join the broadcast. I hope I will. But anyway, you'll have Valeria, Mauricio, perhaps Dale, all the great guys from FX Street covering it. It should be fascinating. Okay, so let's take another look at the charts, and we'll move to events for this week, or perhaps let's see if we have more questions here. Yeah. Question from Fabian. Given the low liquidity, what kind of impact euro-dollar do you see today from ZU CPI housing market index? In general, I would say a stronger impact than we've seen in recent weeks. That means lower liquidity means every small surprise can have a bigger impact. I think the euro could rise in a strong ZU figure because that would lower the chances, in theory, for any kind of move from the ECB. Okay, and regarding CPI, I believe that could be positive in the US. Remind markets that the Fed is about to hike. And that would, of course, be anyway. But if we have a small miss, it could be big. So I believe we'll see a positive reaction from for euro dollar from ZU, a negative reaction from US CPI. I think both will just beat expectations. And the housing market index, you're talking about is Schiller. Let me take a look at the charts. Sorry, the calendar. Which figure are you referring to? I would be glad to answer. Not the New York State CPI. We have a Red Book Index, which I think is quite 30. Sorry, yeah. The NAHB Housing Market Index. It's given here sort of medium importance. I think it leans a bit lower, especially that we have CPI, and especially in the background of the Fed tomorrow. So expectations are for a small rise from 62 to 63. We would need a huge negative surprise of 50, let's say, for it to have a significant impact, or 70 to have a positive impact. I believe it'll be a bit ignored. CPI should have a stronger effect, and the Fed should have a stronger effect. Tomorrow, of course, we'll have a full preview for the Fed. So I hope this answers your question. Yeah, thanks. NAHB housing market. So yeah, it's not that important. I see CPI moving markets. Yeah, if we look at Friday on the consumer confidence, we did see markets moving a lot on that secondary figure, but today is not Friday, and today the tension is a bit higher. On Friday we had wilder action. Okay. Let me also. I heard this theory on this podcast yesterday. Let me share it with you, maybe. FX Robot, I would appreciate if you would not post your links to your site every few minutes. If you want to ask questions, you're welcome. And you have your Twitter account as well, as Jax mentioned. But please just don't bombard everybody here with links. Okay, you did it once, okay, but that's enough. Thank you. So I heard this theory about that there's so many options now about to expire in New York, and with low liquidity, if we have some big disappointment from the Fed, if we have a big hawkish move from the Fed, if we have the Fed saying something like, we raised rates now and we're going to raise rates even more in the not so distant future. It means, let's say, 4 hikes next year. Very strong message for the US dollar, very negative for stocks. So if we have a hawkish message together with some kind of promise for more hikes, then we could see stock markets tumble, and with the options, this could exacerbate the situation, causing a huge crash on Wall Street. I don't know if I buy this theory. Let's take a quick look at this in P. Just an anecdote of something to watch. Where did the S&P run away? I don't know if you buy this theory. It ran away anyway. Well, I have some technical issue with getting it up the screen. Anyway, we have euro dollar falling a bit at the moment from the highs during the show. Again, low liquidity, high tension, all of that. Okay. Let's see if you can pick up some news that came out this morning. Do you have any more questions? In the meantime, I'm happy to see markets moving, of course. We had the Bank of Sweden leaves the interest rate unchanged at minus 0.35. We had Juncker, which is one of the hotshots in the European Union, saying that economic recovery is fragile. That could depress the euro, but it's not news, and he's not so influential as we've learned. We had a comment from OPEC saying that the current oil price will not continue, but on the other hand, there's no intention to have an emergency meeting. So he says that the oil price will just change. It'll just happen, just as is. Yeah, we're seeing some kind of stabilization in oil prices after the big crash and big rebound also yesterday. So these are the news going on during the show. I remember the Swedish Riksbank has an interest rate that is lower than the one of the Eurozone, so there you can always dig to lower ground. Okay. Question, Jack, shouldn't Wall Street be strong enough to withstand an upcoming news event, or are they that fragile? Yeah, well, I agree. First of all, I think they are able to withstand that. The Fed prepared us for so long that the rate hike is coming that should be a surprise to nobody. And they also told us that the message will be gradual. So Wall Street should be very well prepared for everything. But we have this gloomy atmosphere in markets. we had the crash of oil prices, and this has impact on junk bonds. Many of the high yield bonds, if you want a positive term, or junk bonds, are fragile because with lower oil prices, you have lower chance of paying back the loans. So we're seeing these high yield bonds or junk bonds suffer a sell-off. Some companies will go bankrupt. Of course, that's part of the game. That's part of capitalism. You win some, you lose some. Creative destruction. But this could, of course, spread to healthier stocks, and with the Fed rate hike. And so this is the gloomy situation. Again, it's a theory. I think we will see a slide in stocks because a hike is a hike. Stock markets want cheap money and not tight money. But again, it's been telegraphed for so long that it will be a surprise to nobody. Okay, so it's time for the wrap up for today. So this is the wrap up for Tuesday, December 15th, one day before Fed Day. This is what we had in markets yesterday. We had oil prices fall very sharply under $35 on WTI and rebound quickly. Draghi didn't impact the euro by saying nothing. He also enabled the euro to rise. In Australia, the meeting minutes were sort of normal. They see the fall in the Australian dollar as being in line with commodities. Nothing to see here. Move along. Today we have a much busier calendar. Inflation data from the UK at 9:30 GMT. Okay, expected to see a rise. We're expecting a small rise there of 0.1 in headline inflation, and that could support the UK. The pound, which is looking for direction. The Bank of England is worried about inflation. At 10 GMT, German Zone Economic Index, it's expected to rise from about 10 to about 15 points. And I think that with low liquidity, it could give another boost to the euro, help it recover from the slide that we've seen in the past half hour. But who knows, maybe it'll disappoint. Of course, inflation data, that's the main event for today in the United States. Core inflation is the key figure to watch, expected to rise year over year from 1.9 to 2%. Also watch headline inflation, but core inflation is more important in the United States. It's also part of the Fed's mandate. 1.9 will be, I think, dollar supportive, and any beat will be positive. Miss will be negative. I think markets will be very sensitive to this figure. It will probably overshadow the U.S. Empire State Manufacturing Index because everybody knows that the state of manufacturing is not good. Canadian manufacturing sales, and then we had Fabian mentioned the house index. I think it will have a big impact only if it's a big surprise, not if it's around expectations, small miss, small beat. But core inflation, any figure will move markets. Okay. Canadian, New Zealand milk prices, another rise will be welcomed by the bullish Kiwi. We had a rise in the previous auction after 3 consecutive falls. And the Bank of Canada, Stephen Pallot's talks. Let's see if he provides us a hint about a rate cut. Expectations are for nothing special, but I believe that given the fall in oil prices and given this previous speech about lower bound, he may give us a hint about lower interest rates in Canada, and that could negatively impact the Canadian dollar, which is already moving by oil prices. Looking at the charts, euro dollar 110.30. Sort of 110.70 is resistance. Basically, it's a bit choppy, not really respecting lines very well. We have it's a pair to watch today. Euro dollar, also the Canadian dollar. These are the currencies to watch. Pound dollar, 150, 154, 44 quite stable. 150, 115, and 152 are levels to watch. Dollar yen. The yen is enjoying safe haven flows and relatively good data from Japan as well. 120 is the round level to watch. 122.20 is the high. But we're seeing here a series of lower highs, but not necessarily lower lows. Let's see what's next for this pair. Dollar CAD, I mentioned during the show, some kind of risk-on atmosphere, not helping the euro, but it does help commodity currencies. So dollar CAD under 137, resistance, sort of resistance, yeah. The new sky is 137.87. support at 136.20, 134.60. I would say real resistance is at the round number of 140. Aussie dollar in range 70 to 80, highly respected line over there, support at 72.20 and 71.50, resistance at 73.60. Kiwi dollar 68.13, 69 is strong resistance, support at 67.90 and 67. Okay, so we've covered the main currencies. Lots of action in markets. Pairs to watch euro dollar, dollar CAD today, and also the New Zealand dollar. The Fed is looming above everything. Is it overhyped? Perhaps, but it's still. Don't worry, it's moving markets already, and it'll move markets on Wednesday evening, on Thursday morning, on Friday, and next week into Christmas. And of course, it'll continue echoing into the new year. It's really an event of historic magnitude. Okay. Well, thank you everybody for the kind words. And thank you for coming today. Tomorrow we'll of course talk a lot about the Fed, and Thursday we'll talk about the aftermath of the Fed, the before and the after. We'll try not to make bold predictions, try to prepare you for things to watch. Okay, so thank you very much everybody for coming, and wish everybody a safe and successful trading day. Be here tomorrow as usual at the same hour. So thank you very much, and see you. Bye bye.